Welcome back to Group 4610's BuyingRealEstateBlog.com. I'm here today with Sam Ramis of American Family Insurance. Thanks, Sam, so much for meeting with me today. As you know, I work with a lot of first-time home buyers, and they've got a lot of questions around home insurance. Last time we were together, we talked about what is home insurance and when's it required. Some of the other questions that I've had, one of the big questions, and the question that everybody has when it comes to money, how exactly is the cost, the price for home insurance determined?
Well, it's a lot of different factors. It's based upon the amount of coverage that you want, what that home is worth. It's also dependent upon the zip code that you live in.
Okay.
It's also, like many companies, American Family uses credit and claims history of the person getting the insurance to determine what they're going to pay.
Okay.
And then another big factor is on your insurance if it's replacement cost or if it's actual cash value. So if your insurance is replacement, then you're going to be repaid exactly what it would cost to replace the item that was damaged.
Okay.
If it's actual cash value, then what you get paid is the amount that the item that you own is worth minus any depreciation that it's gone through.
Okay. So basically what the insurance company determines that the value of that property is, or the value of the item is, that's what you would get back, not necessarily what it would cost to replace that item. Is that correct?
No, really what it's going to be like kind value.
Okay.
So if you have a 10-year-old TV that maybe cost you, let's say, $5,000, but with the way electronics go down, maybe that same quality of TV or the same size of TV now only costs you $1,500. They're going to replace it with the $1,500 TV, so you have a like kind TV.
Okay. All right. That makes sense. Something else that you brought up has to do. You're talking about that you guys use credit to determine the cost of insurance. Do most insurance companies use credit to determine that?
Most of the large insurance companies do. The thinking is that the more responsibly that you handle your credit, the lower that the claims are going to be on that particular property.
Okay. Which, in most cases to buy a home, you've got to have, at least above 620 credit anyway. So it's not like you're dealing with people that are, in the 400s to purchase. So another question that I had was around the claims history. What exactly is the claims history on a house?
What we can do is we can take a look at, let's say, a given period of time, typically about 5 years, how many claims that individual has had of where they've lived in the past.
Okay.
And so if they have a pattern of a lot of theft claims or damage claims, things like that, then the assumption is that those types of claims are going to continue. And so that particular individual might be paying a little more for premium in the future because of his previous claims experience.
Okay, so it's not necessarily based on the claims that have been on that specific house with previous homeowners, or is it both?
No, it's on the individual, where the individual lived before.
Okay.
So for first-time home buyers, they don't really have any claims experience. So there's really there's no good information being reported and there's no bad information being reported. So it's really a wash.
Got it. All right, great. Well, thanks so much. That's valuable information for me. I learned a few things there also. So thank you guys so much for stopping in. Once again, this is Sam Ramis with American Family Insurance. If you'd like more information about how to get a hold of Sam, just go ahead and send me an email. You can just click on my contact information on this page, and I'll gladly hook you up with Sam so that you can get started on your home insurance. Thanks again for coming, and I'll see you guys soon.